Hello and welcome to another video. In this video, we are going to talk about accounting for bad debts. This is a continuation on the video for provision of doubtful debts. So first of all, we are going to look at two types of doubtful debts. The first one is called doubtful debts, another one is called bad debts or irrecoverable debts. A doubtful debt is an estimated sum of trade debtors or accounts receivable which is expected to be uncollectible. So basically this statement is trying to say that it is an estimate that there's some percentage of your accounts receivable that will not be collected. It is an estimate. You may receive it, you may not receive it. That is the key. It's not for sure that you will not receive it. Whereas with bad debts or irrecoverable debts, it's those trade debtors and accounts receivables that will not be collected. So in doubtful debt, it is expected. In doubtful debt, it is expected, whereas in bad debts or irrecoverable debts, you are sure, or the company is certain that, or the company has determined that your accounts receivable or trade debtors will not be collected. There are two methods of recording bad debts. There are two methods of recording bad debts. One is called direct write-off, and the other one is called allowance method. In the direct write-off method, you remove the uncollectible amount directly from your accounts receivable and record that bad debt as expense in income statement. This goes in income statement. Whereas in allowance methods, it estimates the likely amount that will not be collected. So it is an estimation. For this, you can watch my video on provision for doubtful debts. Moving on to the journal entries under both the methods. So journal entry for direct write-off method, journal entry under allowance method. So if you're following, or the company is following the direct write-off method, you will debit bad debt expense. If you remember, expense is a debit nature account. Expense is a debit nature account. So you debit bad debt expense because you are not going to collect that money, and then you will credit accounts receivable. Since you are not going to collect that money, it reduces your accounts receivable. What is an accounts receivable? Accounts receivable is an asset. Whenever an asset decreases, you credit the asset. So you credit accounts receivable because you will not receive this money. Similarly, if you are following allowance method, or the company is following allowance method, you debit allowance for doubtful debt accounts instead of bad debt expense. So you can see the difference. This is the difference. It's the account name which is the different. And then you credit accounts receivable same as under direct write-off method. Let's look into an example following the direct write-off method. Company X, during the year, company determined that customer ABC, a debtor owing $500, will not be able to pay. So during the year, it could be any year, the company X determined that customer ABC will not pay $500, will not be able to pay $500. So under direct write-off method, you will debit bad debt expense. You will debit bad debt expense of $500, and then you will credit accounts receivable. You will credit accounts receivable by $500. So this is the same entry, and this is the answer slide. This is just an answer slide. Moving on to another example on allowance method. It's the same example, but now this time we will make an entry under allowance method. So company X, during the year, company determined that customer ABC, a debtor owing $500, will not be able to pay. And now we will prepare the entry under allowance method. So under allowance method, you will debit allowance for doubtful debts, and then you will credit your accounts receivable. You will credit your accounts receivable. So this is just the answer slide for your reference. Now we are going to look at the example of recovery. So what I mean by recovery is basically if the company decides to write off the bad debt, if the company decides to write off the accounts receivable, it is possible that in near future or at any time, the debtor could pay back to the company. So that is called recovery. So we are going to look at the entries. We are going to look at the entries of recovery under direct write-off method. So company X, during the year 2001, company determined that customer ABC, a debtor owing $500, will not be able to pay. So in 2001, the company made an entry. The company would make an entry on bad debt expense under the write-off method. In the following year, 2002, company X received $500 from customer ABC, previously written off. So in 2001, the company wrote off the accounts receivable, and in 2002, company X received that money from customer ABC. We will prepare the journal entry in company X books for the recovery and the cash collected. So let's look into the answer. So the answer would be debit cash $500 and then credit bad debt recovery income $500. So this is the entry for recovery and cash collected under direct write-off methods. And this is the entry for year 2002. So if it was 2001, company would have done debit bad debt expense, and then credit accounts receivable $500. Same entry we have seen before. This is the same entry we have seen before. Let's look at the same example under the allowance method. So it's the same example. In 2001, the company is going to write off the debtor, and then in 2002, the company will receive $500 again. So in 2001, the company would have made this entry: debit allowance for doubtful debts, and then credit accounts receivable. But in 2002, company received the money back. So the first step would be to reverse this entry. So to reverse this entry, we will basically do debit accounts receivable and then credit allowance for doubtful debts. The company received cash. So there is going to be another entry in 2002, that is debit cash and then credit accounts receivable. So these two entries will fall in year 2002. So here is the answer for your reference. The first entry is the reversal entry of 2001, and then this is the entry for cash collection. To summarize this PowerPoint, there are two methods to record bad debts. The first one is called direct write-off, and the other one is called allowance for doubtful debts. The most common method used is the allowance for doubtful debts method. Thank you very much for watching this video. If you like this video, please give it a thumbs up and subscribe to my channel for more videos on accounting. Thank you very much.